how to get a loan or money to invest in a self-storage project. That's what we're covering on this video. And we came out here with Live Oak Bank, who is the largest SBA lender in the United States based upon dollar volume. We're going to show you the differences between SBA and conventional loans, what you need to be prepared or what to expect, and how to actually get a self-storage facility bought. If you're a new investor or one that's looking at SBA loans or even traditional financing, this is going to break it down so it's easy for you to understand, so you are not intimidated. In fact, you see all the opportunities that are available for you. We're even looking at actual examples of people within our community and Live Oak Bank working together to get done a conversion project as well as standard self-storage investment strategies.
So taking a look at this is a very typical small SBA acquisition. If you look here, you'll see that the borrower's equity is roughly 10% of total project costs. The other use of proceeds items you'll see are typical closing costs, including an appraisal, environmental report, legal fees to draw up the loan documents, SBA loan packaging fee, title work, etc. One thing that's cool about this one, because it is under $1 million, is there's no SBA guarantee fee. Because there was, a little bit of lag time for them to raise the rates to get to the cash flow being stabilized, we did help them out with about $50,000 of working capital to help them make some cosmetic improvements to the property, but also just to have general working capital in the account.
So we have a property that at the end of the day, when everything, the total amount is $761,000. Now, but the property sold before, obviously, the fees, everything has to get done, $685,000, and they came up with $76,000 to put down, and then obviously the rest was covered. Now, you mentioned, which is a really important part, especially when dealing with value add, that time period in which to stabilize it. Were there anything other specific with terms or the property that you were kind of looking at, prepayment penalties, or did they want to be able to refinance in a certain period of time? What were other things they were looking at?
So for this project, this was something that was close to the customer, close to home. It was something for him that was kind of a buy and hold opportunity. Mm-hmm. So with an SBA 7A loan, there's a 3-year prepayment penalty, but that really wasn't impactful to him because he said, I know I'm going to own this for the long term.
And he's got to turn it around anyways, which it's going to take time.
Yeah. Exactly. I like to say that SBA is a little bit of like a stepping stone financing. It's a 25-year amortization in term. And if you want to stay with us for 25 years, we'd love to have you. But for a lot of people, I would say the average tenure on our books is probably 4 to 6 years, because typically they'll buy it using a higher leverage SBA loan, and then under their management, it's run better, it's making more money, it's worth more, and then that's when they may refinance it conventionally, maybe get a CMBS loan, or maybe sell the property. But they're doing all of that after that 3-year prepayment penalty has passed, so there's no detriment to them.
And that's pretty traditional. We see it, if we ever look at turning around, that may be an expansion fill up or operations. We typically plan on 3 years, because 3 years sounds like a long time, but particularly in storage, that's 3 busy seasons. Now, with this person, this was a local one. You mentioned before that they'd looked at other properties that just weren't right. Yeah. What properties were they looking at, and why didn't those work out? What were your thoughts, and how did you help them come to the conclusion that this was the correct property for them?
Sure. So I think for the first property that they looked at, I think they were just casting a wide net. It was the first storage facility that they got. But kind of taking a look at it, it didn't really support the leverage that they were looking for. And so that one just kind of didn't pencil out unless they were going to put a lot more money down. And that's just not something that they wanted to do. The second property, they got excited about it. They went and looked at the property. And then there was kind of some disagreements with the seller, and maybe the financial records that they were given were not exactly accurate. Mm-hmm. And so they just got a gut feeling like, this isn't for me, and they walked away on that one on their own. When they brought this one to me, it was a really easy loan for me to say, like, yes, I feel good about this one, because it was purely a rate play. This one was already there, it's already full, and we could see from other competitors that are the same kind of asset type have higher rates. So it's not really that much of a leap to say if you're 30% below market and you're raising rents, and you can see other people are doing that and they're full as well. It's not that much of a leap to think this guy can do it. And his expenses that he projected were very realistic. So it was really easy for me to get behind those projections. And especially because it was so close to him geographically, that was a big bonus.
Yeah.
Because if you're a first-time operator, it's always easier to find something that's within driving distance for you versus buying something that's several states away.
Yeah.
So that's one thing that I really liked about
And how
this
much
loan.
they knew about the market.
Yeah,
Because it being that close, they had a really good feel for that market. And so I'm sure that gives a lot of confidence for you. Now, talk to me about the working capital. Where did you see the need for working capital? If we have a 3-year to get everything turned around, was that a cash flow hedge? Meaning that we have this and we're using it for cash flow as you're turning it around? Or was this working capital to be put into the facility? What were they trying to accomplish with pulling out an extra or having an extra $51,000?
It's a little bit of both. So there definitely were some cosmetic improvements they needed to make right away. And a lot of that was like landscaping, kind of refreshing the sign, making it look like a safer place, a more inviting place. So it was a little bit of that, a little bit of kind of a cash flow hedge. $50,000 on a project of this is, actually a pretty good chunk compared to the other use of proceeds. So for him, it was all about getting the facility looking nicer so he could command those higher rates, number one. And then number two is it was a nice cash pillow. And based on his projections, this was a little bit more than he probably needed, but I'd always like to be a little bit conservative just in case, okay, you thought the sign was going to be $6,000, it ended up being $10,000 or something like that.
Yep.
And this was a really strong person, especially given the size, was a really strong guarantor, had very high outside income. So if he needed to inject more money into the project, he could. I just wanted to make sure that was in the financing. That way he wasn't having to dig money out of his pocket after closing to get things where he wanted it to be. And
did he come up with the $76,000 himself, or did he bring in other people you had to look at? Was that just him?
Just him. So
Perfect.
This was it's a smaller project, smaller equity injection. So it was 100% his savings. And we have customers that do that. We also have customers that are raising money from investors. So a lot of people think that maybe they can't get a loan if they're raising money from investors. That's okay. We always just want to understand how much are you injecting personally. So we do want our customers to have some cash into the deal, because then we feel like they've got skin in the game when it comes to it, and they're not just signing an empty personal guarantee.
Absolutely. Talk to me about how comfortable you felt. Were they running it, or did they hire a third-party management company? They got the working capital, they're buying it, but that execution part, who was going to really do that?
So this is a smaller facility, so they really didn't need a full-time manager. They had kind of hourly help that they would kind of pay as needed. And it was already full as well. So a lot of times your manager is doing a lot of the work with leasing if you have a manager in place. For them, it was really more of a maintenance person that they were hiring, mostly for just general maintenance, a little bit of landscaping, and then also overlocking.
And they were going to handle the rest, the back end stuff.
Yeah.
Awesome. That's great. This is a perfect example of a smaller type facility, which within our community, this is a perfect example. We see lots of deals that trade at the $400,000 to $1 million mark. And I think a lot of people don't know that or understand that. They think commercial real estate, lots of times they're buying facilities that are cheaper than duplexes in most major markets. And this is a great way for them to invest in what would have been a $600,000 home or something like that, save up a down payment, put it in, they get a cash flowing asset, they can refinance it later on, and you guys are right on board with them and building that. I thought this was an awesome project and a really good one to use as an example.
Yeah, and the other thing that I like, just to add on to that too, is that he's putting 10% down. So if this was another bank that said 25% is our minimum thing, that might have tied up more of his capital and he can't buy another one.
Or he may not even be able to buy it, period.
Yeah, exactly.
Okay, so this one is more complex and exciting because it's complex in the best way possible. So this is a conversion, and basically we have a warehouse. The warehouse wasn't being used, so they bought it and they built in storage units inside, and then they had a storage facility. Conversions are great. We've done them with bankrupt Super Kmarts and office buildings. I love them because you can get into great properties. You have most of it already built. And there's a lot you can do with it because it doesn't have to go through the ground up process, and that shortens time. Lots of pros. But this was bigger than a traditional SBA loan ability. So you have 2 layers, which is really interesting how you guys were able to work with them and pull this off. So walk us through how you structured this financing deal.
So I love conversions personally. If you can get the building for cheap enough, the cost to convert is so much lower than the cost of ground up construction. And this was a New England market with super high rents for climate controlled storage. So it just was great in that respect, where we had lower construction costs, but then we're going to get these high rental rates once it's built. And so the way that we took a look at it, obviously we had to buy the building with the loan, and then we had our construction budget in there. We had some architect and engineering work to transform this 5-story warehouse into self-storage. We do 10% contingency on our hard costs, and customers are like, that seems like a lot. But typically, people are more likely to run through their entire contingency budget than never touch it at all. Yeah. So it's always good for it to be there. If the end of the construction, you don't need all your contingency, we can reallocate it to your operating capital reserve. But it's always just good to be there in case something comes up.
I mean, the last 4 years, the price of materials were changing so wildly with inflation, everything going on. So definitely better to have it than not.
Yeah, absolutely. So we did have an interest reserve in there for $500,000 because this is a large loan. So the interest on it as it's being built is substantial. So we had an interest reserve in there to make payments on their behalf during construction. You got your standard legal fees, your SBA guarantee fee because it is over $1 million. But this is the most important piece of the use of proceeds, in my opinion, and this is where other banks miss the mark all the time, is the operating capital reserve. A lot of banks look at this and say, oh, you're converting a warehouse. It'll take you, 12 months for construction. We'll give you 12 months of interest only, an interest reserve to pay for the loan during construction, and then you'll be operational. But self-storage takes a while to lease up to the point where you are able to service your debt purely from business cash flow. So if you don't have an operating capital reserve built into your financing, that means it's going to come out of your pocket once the facility is operational. So to me, this is the most important part of that. And so we took a look at the monthly feasibility study projections to figure out, okay, how much money do they need to help cover their expenses, cover their loan payments until they get to their projected break even. And so for them, that was about $750,000. And so we could build that into this nice 25-year loan. So as you said, this is a big project. It's actually above the SBA 7A max of $5 million. What we do at Live Oak is we can add what we call a pari passu loan. It's basically a conventional piggyback loan that mirrors the structure and terms of the SBA loan. So it's a way for us to accommodate larger projects, but still use that SBA 7A program.
So you're stacking it. You got your SBA, you got your thing, and then you're just taking a conventional and making it look like the SBA loan. Yeah. So they get the same benefits that they would, even though it was capped out at 5.
Yeah, same interest rate, same term, there's no balloon in there. It really is just kind of like an extension of the 7A loan. And so for this one, this is construction and then lease up. So we actually did 36 months of interest only here because we wanted to give it about a year to build and then 2 years to lease up before those P&I payments kick in. So this was really fun. The customers were great to work with. They were actually real estate guys, but new to self-storage. One of them was like a broker in the commercial real estate space. The other had like tons of real estate holdings, but they had never done self-storage. So to learn about it, they actually listened to your podcast. And then from listening to your podcast, gave me a call. But they were so much fun to work with. And with their equity, they're still getting higher leverage with an SBA loan, but we did receive some investor money to round out the total equity injection.
That's awesome. Now, when this project, have they already started?
They actually finished construction.
Awesome.
4 months ahead of time. They are leasing up way faster than their projections. I'm so happy for them. They deserve it. But it's a really great market in New England. It's really near a college, really high in-place rents. So they're actually leasing up really quickly.
That's great. And when you look at this structure, a lot of deals we're seeing in the last 2-3 years, people are needing to come up with 45% down. And that eliminates, when you're talking about a deal that is $10 million, that's eliminating everyone, like even real estate investors and big ones. That becomes a big hurdle that becomes really hard to get over. So this kind of structure, this allows them to do in a really good way with someone like you guys that actually knows how this works. So they're not taking unburdened risk and using their capital to secure a deal of this size. Enter into the market, it's a new build, which, in markets like that, new build, new rates, great fill up, that $9 million will quickly be worth way more than that, which then leads them great opportunities to refi, sell, or whatever they want to do. What is their plan with this? Are they going to hold the loan? Do they have any plans on changing? What is the business strategy on the financing side moving forward over the next 5 years?
So they're focused on operating right now, and they were looking at it. And one thing that I did, actually, as part of our process, we do a site visit with them. So I went with them to tour this big warehouse, but they had a huge parking lot. And with self-storage, you really don't need that many parking spaces. And so one thing that I had recommended to them was, okay, in the side lot that you have, why don't you look at these kind of portable units? They look like traditional drive-up And kind of add that there as just additional income. You're probably going to get a tenant that doesn't want to bring something inside on a dolly and go up an elevator. And so they're adding that there. But they're actually, now that they're leasing and they've done all that stuff, they're thinking about project number 2, which is really exciting. So they're looking at other projects. I think they got the bug for self-storage, which is
That's
great.
awesome. Awesome project. And the way that you've structured this and how it's done on the 2 loans to get them there, that is not only creative, but I haven't seen somebody do that. I haven't seen a product like this. So to get, a lot of people would not think that you could get the benefits of an SBA loan on a $10 million project when you're capped out. So awesome example, and good to hear they're killing it. So at the end of the day, they did raise capital. And when you are going out and raising capital, they need a down payment. So you got to get that 10% down. For the person bringing that equity to the table, that can vary a lot. Normally, when you get up into these numbers, like $1 million, nobody's doing that by themselves. They're raising capital. When you're doing that, how much do you look or care about that?
Well, we definitely want to see that someone has a meaningful amount in. And so what is meaningful? And it's really not like a set percentage of the required equity injection. It's more about what's meaningful
to them.
Yeah. So we'll take a look at their personal financial statement and say, like, is this kind of a meaningful chunk of change for them to put in so that they're going to feel really personally invested into this project as well, even though they're raising the rest of the money from investors.
So if I have $10 million in cash sitting in my bank account and I say I'm going to put in $10,000, you may go, come on, let's see. Oh, that's not quite enough.
Yeah, exactly.
Yep, got it. That makes sense. Now, the other thing we wanted to hit on real quick is the leverage portion of this. So when we look at this, the leverage point on this, meaning you have 10% down and 90% debt, right? This is something that works in this project for a few reasons. You mentioned high rental rates, the shell they got, so the buildings they got, and their basis was low, especially what they got for it, which we've done in conversions. Our basis was so low in comparison, that really helped us out. But that is combined with their low basis getting in, what they were going to do, the high rents, which meant the total value of the project once it was completed, right, won't reflect this. It won't reflect, your equity portion is going to be greater. So I'm assuming that you look at that a lot when you say, okay, we've got 90% debt, 10% down, but you don't always do that, right? So then what are you looking for when it comes to leverage, how much leverage you can put on a project?
Right. So for me, cash flow is king. I want to see that whatever debt we're putting on there, the projections can easily support it, break even in a reasonable amount of time, and then stabilize out to a comfortable debt service coverage ratio. So for this one, it worked a little more than 10% down. The projections supported it, and that was great. And if the max leverage works, we'll go for that. But I want it to be clear that the projections need to support it. So 10% down may not pencil every time, especially when it comes to construction projects, especially when you're in a place where maybe the cost of construction is higher. Maybe you're in a state where like labor is more expensive as compared to other states, or you're in a union state that can drive up the cost of labor. So I always want to take a look at how much debt that they can support comfortably. And so for sometimes it's 15% down. Sometimes I tell people this project doesn't work unless you put 30% down. So it really is project dependent, and it's going to be depending on the cost of your construction and then also your projected revenue. So there could be a place in rural Alabama where every place is 100% full, but if they're only getting, $75 for a climate controlled 10 by 10, it may not justify the cost of construction, even though you could rent all of those units.
That makes perfect sense. And a large thing, we talk about this a lot, cash flow is king. It's a business, we're looking at the revenues, right? This isn't an equity play, meaning we're gonna put all this debt on it and just hope that the market goes up. That's nothing we're talking about here. In fact, traditionally, when we look at storage outside SBA loans, they require a higher amount down. So normally if I'm looking for an apartment building versus a storage facility in a conventional loan, the down payments are usually a little more if it was an already existing facility. So when you're looking at those projections, it's not that she's saying, oh, I'm sure the market's gonna be great and it's going up. You're looking at actual rents, like what they are, so what are you gonna get today? So not in the future, but if today they just filled up their renters in the market today, what that would do and change, which would then change that profile. Now, this gets important because the gross revenue has to cover the debt. When interest rates went up, your DCR, or your debt coverage ratio, so how much it costs to cover that debt, that can change a lot. So if it's 3% versus 6%, although all other things may be equal, that also goes into it. Can those revenues cover this debt, and at what percentage? So those are all things that you're looking at and individuals need to look at. Because two, you may want to put more down. As in, you may say, oh, well, you can put 10% down, but an individual may choose to or want to put more down. So those are all things that you'll work with them on when you're building this out, to look at how much leverage you can put on it that is reasonable and appropriate for that project. But in general, SBA loans, one of the best functions is you have an opportunity to put low down. Where I'm assuming I couldn't get this on a conventional loan.
No, if we were do this conventionally, we would want at least 35% down,
exactly,
if not more. So SBA is great. It just makes it a little bit more accessible for people to build it. Even if you're bringing in investors, but if you had to raise even more to get to 35%, you are diluting your personal ownership in it. So it's just a great option, I think, especially for new construction.
I agree. One of the important distinctions we want to make and talk about here is we mentioned like portable units. Now, if I'm going and getting a conventional loan from a local bank, they may look at that and discount those cash flows. What do I mean by that? Meaning they're looking at it as real estate, and those portables that you put out in the parking lot, even though they generate the same income, the bank may say that is not actual real estate. Those are portables, they can leave. So those cash flows aren't as valuable as the real estate. So they actually discount it. It's not worth as much. And that's a big thing that when we're looking at storage and we talk about storage as a business, this is one of the things that we're talking about. As in, we have things like we self-fund our insurance premiums and we get huge amounts back from that. You also have services, truck fees. You can do all of these different things to increase that revenue, which increases the value of the property. You can have U-Haul, right? And when you include those things, it can make a significant difference. In fact, lots of people, it's the difference of their profit margin. And so when you guys looked at this, you didn't discount those revenues. Any thought process on why you don't versus some other institutions or bank, they may greatly reduce the value and impact of those revenues?
I think that a lot of banks are very collateral focused. So they're focused on, this is my tangible collateral, this real estate, this portable unit can move. And so I'm going to focus on what is going to remain. For us, we realize that a portable unit is going to be another income source similar to late fees, admin fees, insurance that you're selling. And so we like to include it in the projections because realistically, that is going to be one of the revenue sources of the facility. And I like it too because it just adds it's a way to kind of take wasted space and make it into something that is producing revenue. And these portable units too, if people think of like shipping containers, they're very slick, they're beautiful. Yeah. There's some that you probably would drive past and would think it's just regular self-storage, but it actually is a portable unit. And two, it's important to remember that if I go to the market, the value of the property is based upon net income and storage. So net income is what creates value. And that if your net income goes from $100,000 to $200,000 because of portables or late fees or insurance that you're doing, right, the property increases in value on the market when you sell it. Now, one of the things though, that when I look at, okay, you're increasing these different lines of revenue, it can add to the total gross revenue, but normally the impact on cost is less. As in, it's cheaper to add in some of those and portables than it is to build from the ground up that, so your return can be higher. Is that something you guys generally see? That the cash flow that you get in relation to the capital put in on portables, is that generally a good return for those people? I think it depends on a little bit on the market, but for us, it's a very easy way to take paved space if you're repurposing something and kind of add that revenue in there. So a lot of times when we're using portables, it's because they bought a facility that has a side paved lot. They don't want to go through the hassle of getting a building permit to add more. So this is a way to add more a lot cheaper than going from the ground up, and it's a lot less hassle as well. And so to me, it's a really interesting way. And I see the trend growing in self-storage. I'm seeing more and more portable units being added as a supplemental income to brick and mortar facilities. Yep. And I think it's driven for a lot of reasons, including the restrictions given. And two, the SBA loan part, this goes back down, I think, into the philosophy. This is a business. We're getting a small business loan here. We're looking at these revenues. We're looking at risk associated to paying the debt and how much we're putting down. And so any opportunity that you can find to increase that revenue to offset, obviously, expenses, you're going to take. It's going to increase the value of the property.
But if you have to get an appraisal, when you go out to get appraisals, when you go out to look at other third parties, do you run into problems with them not seeing that the same way? And if you had an appraiser that came and said, I'm discounting 30% of the revenues, how do you think about that or approach that if you don't?
Yeah, so this is something that we're seeing kind of mixed results with appraisers. Some appraisers, when they're looking at the total income of the facility, they'll include all income sources, including portable storage units. Other appraisers are like, well, but if this could move, then it's not generating income anymore if they take it off site. And how do you feel about that? That's actually something that we're talking about to the larger appraisal firms to say, hey, this is the future of self-storage. A lot more people are using portable units. It is a revenue driver, and I think it needs to be adequately reflected in the appraisal value. It may get different depreciation, obviously, than a big building, but I do think it's something that appraisers are paying attention to and realizing that this is a growing trend within the industry and that they need to adapt their practices.
So if you guys are looking at adding different portable units, whether that's moving trucks, any of these outside, I'd say, brick and mortar lines of revenue, just make sure you're working with them, make sure that you're talking about that you have a good idea on how that relates in the financials to your debt, how they're gonna approach that as a bank, as an SBA loan, but also to the other parties like appraisers. Just make sure that's very clear and shown in the business plan so you're having those discussions up front.
So with these two examples, you can see that we can help you get into maybe buying a smaller facility to building a huge state-of-the-art facility. There's a lot of flexibility within the SBA loan program to help you accomplish your goals within self-storage.
All right, I hope this helped and you have a better understanding of the differences between SBA conventional loans and how you need to work with banks, what you need to ask, and what it takes to get money to invest in self-storage. Everything you need is in the description below. And if you'd like to know more about our community and joining to get help investing in storage, you can go to the description below as well. You can check out the free starter pack to get started in self-storage today.